Well, good evening. It is September 12th, 2023, and I, along with Wes, would like to welcome you to the IBD Meetup monthly overview that we typically provide. This meetup is sponsored by Investors Business Daily, and we have one of the largest membership groups in the country with over 2,000 strong, with people all across the country that tune in and join us each month. So we're happy to put this presentation on to share our ideas and also to disseminate ideas that you might have as well. I've been employing CanSlim tactics for over 35 years now. I met Bill O'Neill and David Ryan in a seminar in 1988, and that really changed my life. I have their first edition over here on my desk, and that became, when I met them, that became for me a lifelong passion of studying the markets because of their success. And I attribute much of my success over the last 30 years to what I've learned from those guys. Most of us are trying to change our financial lives. And to do that, what we're trying to do is incorporate fundamental factors and technical factors to identify what's known as true market leaders. And these true market leaders are companies that can go up many-fold over the next few years. And many of those have been, many of those you're aware of, such as Amazon, Netflix, Google, Priceline, which is now Booking, Tesla, Apple, and so forth. And so every market cycle coming out of a bear market provides these true market leaders. And that's really where you make the majority of your gains in a concentrated portfolio, if you can identify those. And we will talk about a number of those tonight. We don't believe in a buy and hold strategy or buy and hope strategy. CanSlim, in the process of CanSlim, believes that it's important to look at market direction. Market direction is about 70% of the key of generating positive, sustainable, exemplary, excellent returns. There are certain times that you should be in the market, and there are clearly times that you should not be in the market, such as 2000 to 2002 and 2007 to 2009. So we in 2022, we were out of the market most of the time because the market was in a downtrend. So that's important to be on the right side of the market. And we'll talk about that in terms of where the market is, what the market is showing us today in just a moment. All of us tonight, our aim is to educate and connect with each other in this active online community. We will focus tonight on, again, technical and fundamental analysis that's primarily featured in the book, How to Make Money in Stocks by William O'Neill. We'll also cite MarketSmith and investors.com many times during the presentation, which are great research tools that we use from Investors Business Daily. Tonight's agenda will be divided into two sections. In the first section, Wes will take you through our slide deck where we talk about the current market environment and some technical factors and macro factors that we think that's important to look at on a regular basis. And then at the second half of the program, will lead us through a discussion of we'll probably look at 100 different stocks. Many of the people on the call tonight are very interested in identifying what we think are those true market leaders. And we will certainly cover what we think are the leading stocks in the marketplace today. If you're a novice investor, don't fret. Many of us were not novice investors in the past. You don't need an MBA or a doctorate degree to learn about the stock market. You just have to have a passion, and you have to have the right tools to continue to study and have the right persistence and never give up. That's really the secret to achieving long-term success in the market. Tonight, we want to educate you. We want to motivate you. We want to inspire you. Remember, this is America. America is, they've got the greatest innovation and the greatest companies on the face of the earth, and they're going to continue to provide those. And if we can identify those companies, we can take advantage of that and make superior results. So that's what we're trying to accomplish. Now, let's take a look at the current stock market environment. The stock market is currently under pressure. We're in a distribution dominant tape. We've had 3 distribution days in the NASDAQ in the last 8 days. We've had 3 distribution days out of 10 days in the S&P 500. But we're still in a trading range. But last Thursday was an important pivot point in the market because we had a follow-through day. And today we're going to look at the best case scenario and the worst case scenario. And we're going to look from a technical analysis perspective where this correction might end if this market continues to dissipate. Tomorrow's a very important day because of the CPI news, and the market is poised for that. Today, the market moved meaningfully down because of Oracle's results, which were lackluster, to say the best. But we are in the September timeframe, which historically is the worst performing market from a statistical standpoint. So we've got to get through a couple more weeks here before the market can resume its uptrend, if it's going to resume its uptrend. We need additional follow-through days. We need the net new high lifts to expand. And so we need basically more stocks to participate. To this year, recently I saw some data where only 7 stocks represented the gains, all the gains in the S&P 500. The other 493 stocks are averaged up only 4%. So it's been a very concentrated. It's been a very narrow market this year. So with that, let me turn around and give it over to Wes, and he's going to take us through the slide deck, and then I'll come back and we'll talk about stocks the second half of the year.
Okay, I can, take over. Let's see. All right. Yeah, so I guess I'll go through. Well, you can go ahead and review our disclaimer that we typically have. This is just for informational purposes and not investment advice. So usually Roy goes over this, but I'll go over these things that we talk about, I guess I'll go over just the 3 pillars that we always kind of introduce people to for what we think is a well-rounded investment process. First, technical analysis, really the most important, because price is, encapsulates everything, including the fundamentals and the macroeconomic analysis. And if you can understand price, that's probably the most important thing, right, to have investment success. But we'll go over fundamentals and macro, which we also want to be aware of. And these are some of the key things in technical analysis that we care about. I think a good way to break it down is through these columns, these categories of price, breadth, sentiment, and ratios. So the price being really the trend, and we'll talk about that, and you'll see some of these charts in the back later on in the presentation, where we'll kind of touch on a lot of these things that are listed here, like the breadth and these sentiment things, and even some ratios to show us relative performance of some different groups of stocks. And then fundamental analysis, we like to kind of anchor on this this acronym, the CAN SLIM acronym, the acronym that was created through, with William O'Neill in his book, How to Make Money in Stocks. This is the, key criteria that we're looking for. And if you can memorize this and understand what it's really saying, it'll help you, narrow your list down considerably to the best of the best in the market. So, again, this presentation will be mailed out to you. So, if you're not familiar, we suggest you get to know this acronym. Thirdly, macroeconomic analysis. We are Hedgeye subscribers, and we like their kind of broad framework, their major framework of growth and inflation, and kind of understanding where we are in that economic cycle. Currently, I actually think we've been in this quad one for much of the year, and you've seen the market kind of rally. So that would be growth accelerating and inflation decelerating. So that's actually been a good, environment for the indexes and some stocks, right? Although I would say their model wasn't quite right, but for most of the year, they didn't get us in the right quad. But anyways, this is, I like that it's kind of high level and robust in that way. And with that, there are certain assets that perform best in different environments. So, just having this is something in our arsenal. It's in our back pocket to kind of to help guide us. But really, we'll get more into the stocks at the end of this, and that's really what we care about. Our stocks breaking out, making new highs. Is your equity account going up as you're trading? Is kind of the key thing we really care about. But the more you know, I guess the more equipped you'll be. Okay, and so we're including some of these ratios that we talked about, that I mentioned some ratios, and this is the IWM, so the small caps versus the S&P 500. So basically the large caps versus the small caps. And so, you can see, of course, in the stocks that we're looking at, and like Roy said, there's, the 6 or 7 stocks, the mega caps have, continued to propel us forward. It really is similar to 2021. I know in 2021, that was the story as well. You had a lot more upside participation, I think, in small caps, but it was quick moves. But in the end of the year, you looked at your account and you saw the indexes up 20, 25% or whatever it was. And if you were not in those 5, 6 stocks, your account probably wasn't in that same vicinity. But, we had that big pullback in March where small cap underperformed dramatically with the sort of banking scare. And then throughout August, it's been that same story, and a lot of that volatility that we saw in individual names, could have hurt you, right? And you could have given back a lot because of the way that these small caps have reacted in that latest pullback. That was minor on the indexes, but major in a lot of these growth stocks, which we'll look at again later too. So this is something that we wanted to highlight again. This has kind of been a story of August as well, where this 10-year has picked up steam from bottoming in the middle of August. It has picked up some steam, and with that, a little bit of market jitters, right? You can see kind of the inverse relationship in the last 2 months, where it kind of looked like the 10-year was going to break out, right? And it's like the market has done fine as the 10-year is consolidated, but if there's a risk to this thing, getting out of control and making another leg higher, that can't be good for the market. So that's something that we're paying attention to. This, right? It looks like a 12-year base, but I don't know if rates necessarily work that way to base and then break out, but that's what it looks like, right? If we can trade anything with the chart, right? This is a consolidation and possibly, at risk of breaking out to the upside. So something we want everyone to be aware of. Similarly, this is the dollar, and clearly the dollar was a major headwind, just like rates, right? They moved in tandem in 2022, and the market bottomed when the dollar peaked, right, in 2022. So, there's a very important relationship here that we want to monitor with the dollar and the S&P 500. And similar to back in July, right? The dollar bottomed, rates bottomed, and now we've had this kind of leg up, and with that, the quick move in the dollar to the upside, not great for the indexes, we think. Okay, and so I was talking to Roy earlier today. It's like every single week we are having the CPI the day after our meeting, so we continue to kind of talk about this, and it still is a number one factor in the market just because it dictates the policy path of the Fed. And so I wanted just to throw some things out there, always kind of update us or update the group on the number and what's expected tomorrow. And I think my take on it is going to be a little bit different than normal, just a little bit more detailed. So the CPI here in July, it accelerated a little bit, right, to 3.2% in July. That was up from 3.0%. So it's that first kind of that also coincided with the pullback in the market, right? We saw, and it's kind of an excuse, right, for the market to pull back, in my opinion, but it doesn't matter why. There was also a number of other factors like the bullish sentiment we talked about last month too. But we're seeing the CPI accelerate. The Fed nowcast, so I think the best forecast of where they think CPI will be is 3.8% the next 2 months. So that is an uptick. That's potentially going to, another thing that the market could latch on to and spook them. I'm not sure, but of course, we care about the reaction to the news the most. But I just want to frame, expectations of what I think makes the most sense to happen here. And we're going to see the CPI accelerate, the headline number. I wanted to talk about the core a little bit because if there's a positive reaction to the news, I think any justification will have to come from the core. The core is going to decelerate. Here's a chart of the core, and I think this is a chart of the next 2 months going forward forecasting. So that's going to continue to fall, even though the headline is going to go up from 3.2 to 3.8. We're going to see core come down from like 4.6 to 4.2. So with that in mind, I think that's going to, if the market's going to rally on any kind of news item, this would be it. It would be because of core coming down. And I wanted to show us a little bit more inside the core because I think this is really interesting. The shelter component, this is a third of the CPI in general, right? So it's a major portion of the core as well. It's a bigger portion of the core. And you'll see that we have just started our downward trajectory on the shelter components of CPI. This is a very, very slow moving component. And I guess for whatever reason, right, because people don't change leases every year, and there's just slow turnover, and there's an ownership component. But the point is, this has a long, long, long way to go down. And so this is going to be what fuels the downward trajectory of the core CPI over the next, I think, 1 to 2 years. This is going to be a major, major component. And basically, I want to show you how lagged it is based or compared to more real-time data that you get. This is Zillow data that anyone can download for free off their website, and you get their housing prices. You can see, look how far this has fallen, right? This housing price index has fallen from being up 18% to now flat, right? And compare that to where this is, it's 8%, and now it's up 7.8%, right? So it's barely come down within the CPI. The same thing is true with rental, where we have this rental price index up 3% year over year. So both of these things are well below average historically, right? They've more than overshot the mean to the downside with this slowdown in pricing in the economy. So I think that's just interesting to think about. I think I think it's an important detail of what you're going to see in the data over the next 12 months. Not just thinking about tomorrow, right? Tomorrow is just one day. But that's what you're gonna have to realize is happening. I understand oil prices are up. In the near term, that's not good, of course, but um, this is going to be maybe the next story of CPI or of inflation going forward. And I've used this a few times. The producer price index leads the consumer price index. Similar thing where this has come down quite a bit, and it's going to lead the CPI down. So again, the reaction, we'll see what the reaction is tomorrow. But this is kind of how I'm thinking about it in the broader picture versus just tomorrow. Okay. And the other thing that happened, I guess, in the last couple of weeks, I wanted to touch on this JOLTS data spurred a follow-through day in the indexes. And this is the job openings and something thing, but this is the non-farm job openings out there, right? So if there's a bunch of job openings out there, there's a lot of demand for labor. If there's fewer jobs available, that means there's less demand for labor. So the Fed is looking at, they've cited this data a number of times, and this is kind of a indication of balance in the labor force, right? And so the last thing we need, this core component of CPI is going to come down through shelter. It's going to come down through wages as well. And so the follow through day really kicked into gear at maybe 10 a.m., 11 a.m. when this data was released, showing that the job openings had come down quite a bit. So there's been some weakening in the labor market. And that should relieve some pressure on wages and also on inflation. So this, I thought it was interesting that the market really latched onto this data point. But here's the chart of the NASDAQ, and highlighted, pointed out there, the day that the JOLTS data was released. And if you could see intraday, it was within 15 minutes that the market was probably up 0.5% on that news.
Wes, let me make a comment right there on the NASDAQ. For those of you that are technically minded, the NASDAQ it potentially is tracing out a head and shoulders top right here, where you've got a left shoulder, the head, and then the right shoulder. There's the left shoulder, then the head up there at the top, and then the right shoulder. Now, we'll clearly find out. This is going to be pretty imminent in the next few days. It's whether we break that down trend line, which will be extremely bullish, or if we violate last Thursday's low. When we have a follow-through day, which typically ignites a new uptrend in the market, you don't want to see that first day. You don't want to see the low of the follow-through day fail. Typically, when you undercut and close below that, then the odds are that the rally needs more time or the rally will fail. So I think tomorrow is going to be an important, it's going to be an important point from whether or not we break out to the upside, which would be quite bullish, or whether or not we take out Thursday's low. So it's important not to guess one way or another. We'll just wait and see what happens, but the reaction tomorrow is going to be important.
Yes, thank you. And I mean, you just draw trend lines, and I think it works. It's important, and you can see how similar kind of action in March. It's just it does repeat itself, this kind of stuff. And the super volatile shakeout here, and the quick recovery broke the trend line, and things started to improve. So we could easily see that kind of action through that trend line. It would be, like he said, I think we agree it'd be very bullish to overtake that trend line.
And it does translate on the downside to a 13,000 level on the NASDAQ if we undercut, if we fail that Thursday low, and then undercut the August bottom. We'll probably surge down and probably bottom somewhere between 13,000 and maybe the 200-day moving average.
Okay, so here's a look at the IBD 50, just the kind of index that measures the temperature of growth investing. So since August, we've just well, we know we saw a major pullback in growth stocks, down from 27 to 22. That's almost 20%. So tough to stomach, right? If you're just going to hold things down that much, very difficult. But since then, had this bounce, we were oversold in the market, and we do have that buy signal actually on the MACD with this FFTY since then. But as of now, I mean, it's not really in. It's not like this is in an actionable spot, but it's just to go as the temperature of growth investing.
Yeah, and back up, Wes, one second. And we have talked about this because we've been in this bear market in growth as measured by the IBD 50, the IBD Mutual Fund Index, the IBD 85 index, which is very important in terms of providing setups in growth stocks. So when we go back, we've had charts that we've featured on this FFTY before, going back several years. This really is as bad as it's ever been in the last 8 years, really. I mean, we've rarely had a situation like this where growth is so underperformed, and CanSlim is underperformed. And so that's why it's been difficult to make money in growth stocks, because this index is the benchmark, and that's a picture's telling you 1,000 words.
Yep. Okay, and so we'll go through the back of these charts where just we go through every month now, and this is the NASDAQ and the MACD in the bottom panel, that measure of momentum. There's right, this is close to a sell signal, right, as well. If we fall through the downside, you get that MACD rollover and sell signal, kind of confirming that. So we are on this crucial point, and with a lot of these things, that'll be kind of a theme, I think, as we go through. And we talked about this downtrend line. We think this is an important trend line to get through to kind of propel us forward through the end of the year. This crucial Thursday level, we think, is important. And you can see, we're right here at the 50-day, below the 50-day right now. This 10-day and 21-day moving average, we like to use, as you maybe know, the 21 or the green line above the magenta line. We're in an uptrend. If it crosses below, we're in sort of a short-term downtrend in our view. So, we need if we expect to go up, we're going to need to be above the 50, keep that short-term average above the 21-day moving average, and have these sort of perfect alignment of moving averages, kind of like what we saw back here when the market actually recovered and some stocks started to work more meaningfully, right? So the whole time from the March bottom, right, and yeah, from the entire time from the March bottom, when we had that follow through day and the trend changed, it was a much easier trading environment. So we're still in this kind of tricky area where we'll see. I think we'll see quickly which way we kind of resolve direction. And so, okay, here's our look at the long-term trend. We like looking at the NASDAQ versus 30-week moving average. This is the weekly chart. We've been in that uptrend in the weekly basis for much of this year. Okay, and then we'll look at breadth. So the S&P 500 versus the stocks above their 50-day. I think that as we look through a lot of these, I think that while price is kind of in this tricky situation compared to the trend, we are not at a point where it's like overly, it's not frothy at all anymore, right? All the froth has been taken out of the market. We're close to oversold, I think, on a lot of these different indicators. I think is what we'll see as we go through some of these, right? So the S&P 500 and percent of stocks above their 50-day, that's come down to 35%. Right, looking at the 2022 bull or 2022 bear market, the worst parts of it, we were at about 10%. So unless we're about to start an epic leg down. We should not see that level again. So we could be, very, very close right here to bottoming in this indicator and seeing some improvement in breadth. I think the same thing here with the 200-day. So this is the stocks above the 200-day in the S&P 500. While we've come in a lot on this indicator, if this is a normal type of pullback in a bull market, then this should be as low as we really need to go. It shouldn't go much lower. We saw it hit 40% twice this year so far, with a couple of kind of, rough pullbacks, that March pullback that brought us down to 40%. But we did not actually see as much deterioration in this last pullback.
And Wes, if we take out Thursday's low, you can keep this chart up right here. This is good. If we take out Thursday's low and then you take out the August bottom, it suggests that we go to 4,200. So really, that's not, that could be 5 days of really nasty short-term action, and then the low is in. So it's from an index perspective, we're still on a buy signal from a long-term index perspective. So you don't want to get cute here when you don't want to go 100% in cash and then we bottom at 40. You have to be prepared to buy at 4,200 if you want to exit right here. So you've got to be on your toes, because we don't feel like the ingredients are there in the market. The economy is still performing great. We don't think you're going to have like a 20% correction from here. At worst, move down to 4,200. That would set the stage for a great year-end rally, if that in fact occurs. If the news is good in the next couple of days, we break the downtrend line, we could retest the highs by the end of the year.
Great. Yep. So this is looking at the NASDAQ versus the stocks above the 50-day in the NASDAQ also. Same story where we've come in a lot in this number, but we are getting close to that level. This was the March bottom. Again, there's less room to go on this indicator, I think, right? So while we're talking about risk to the downside, a lot of these things are saying, okay, well, a lot of the risk has already been accounted for in a lot of these indicators possibly, which is why you got to be ready for both ways, I guess, at any point, especially breaking that trend line. Right in the NASDAQ, the percentage of stocks above the 50-day are at 27%. In March, when all hell was breaking loose and banks were going to zero overnight, there were still 20% of stocks above the 50-day. So we're not exactly in that situation at the moment. So there's been a lot of damage under the surface in this pullback with that. And the same thing, here's the stocks above their 200-day, sitting here at 33%, really close to that level that we've been at, really close to what we bottomed at from 2023, the rest of the year. So, a lot of damage under the surface. We knew that was the case, right? We highlighted that, I think, May, June, July. We were talking about the divergence in breadth, how there wasn't the breadth confirming this move up. And so now this time, let's see if we get that breadth confirmation and can really get moving. Here's the S&P 500 and the advanced decline line. Another measure of breadth. It's I guess I don't really have much of a comment on this. It's much healthier than the NASDAQ, which we can look at here. The NASDAQ kind of continues to work lower in the advanced decline line, so just showing you the participation. It didn't really pick up in June, July. Didn't see a whole lot of movement. You do want to see that to really show a healthy market, but didn't get that with that big push up, although you could still find some things working. But this still, continues to trade along the bottom while the index is.
Yeah, that's at 15-year lows, by the way.
Yes, this is true. Yes, good point. Okay, and here's a look at the net new highs. So Right here in black, we have the new highs that are new stocks that are making new 52-week highs, and in the red we have stocks that are making new 52-week lows. And down here we have the net of that number. So blue being when there are more new highs than new lows. When that's happening, it's going to be, it's an easy dollar environment. You have a really good chance of buying stocks that are going to make new highs. And we've gotten that kind of action twice this year for brief periods of time. But quickly, as soon as you see that deteriorate, the indexes have rolled and a lot of these stocks have gotten hit. And you can see, if you were to heed that warning sign, August 1st, where we flipped negative, that would have been a good, a good time to actually to exit and heed that warning and save yourself some volatility in the portfolio. And just this is a little bit longer term of chart, 5 years, same chart, and still, more context. Here we are in November 2021 when the market peaked. That's that was very well timed there as well. Where new lows were happening. So interesting divergence. There back in 2021 where we were having new lows, or net new lows, despite the indexes pushing to higher highs.
Wes, point out the 2020 bottom there.
There she is.
And guys, that's, for just to put everything in context, we need blue, like this last chart down here at the bottom. We need a sustained period where it's just blue and then it gets even better. And see, the environment's not going to change until that happens. So we're consolidating. We're not too far away. We had a false start in May, May, June, right there, May, June, July. Things looked better for a very brief period of time. But bull markets last normally 3 to 5 years. They're not typically over in 30 days. So when you see the net new high list convincingly turn blue, and stay there for a month or two, or 3. It will be fully game on. So really, we're sort of waiting for those conditions to improve, but that's what you want to look for. And that gives you great feedback, of course.
Okay, this is one of our favorite oversold, overbought indicators, the McClellan oscillator, and I think it did a really good job in this latest pullback in helping you kind of understand where we might bottom. So back here in mid-August, kind of understanding that we were oversold, similar to the level where we were in March of this year as well. And we saw that subsequent bounce, almost overbought, and now back to the consolidation for the last few days. Okay, and the VIX continues to look good, right? It continues to look like we were in this lower volatility environment coming basically out of the banking crisis, where we've continued to kind of drift lower, and we've had these brief pickups in volatility like we did in August, but we're still kind of it does look different, right? This is a lot different than what we were seeing prior to this, especially in the 2022 bear market, where we were kind of bouncing around 20 to 35 in the VIX. Now we're bouncing around 10 and 20 for the last 8 months. So, even though we had this pullback, the VIX only got to 18, and there's just not been as much volatility, and that is a very key ingredient for a sustained move upward. Okay, and so now we'll talk about some sentiment. I guess the VIX is sentiment too, but this is some other anecdotal information that we look at. This is the National Association of Active Investment Managers, and what they have down here is the percentage long based on a survey that these active managers are. And this one was, did a really impressive job, really top ticking the indexes here back in June and July. I guess that's July, right? And the index hit 100%, right? So the managers couldn't get any more long, and shortly thereafter, the index is pulled back, and active managers had to pull in their horns a little bit. And so now, we're at this point where this doesn't go a whole lot lower than it did 2 weeks ago. So that should be that's kind of in the bullish bucket, right? If we have buckets of bullish and bearish. Bearish, we have this continued CPI nonsense where we have to worry about inflation and we don't know what's going to happen. And stocks have, come in quite a bit, but in the bullish camp, we're going to see a lot of these sentiment things are in a totally different spot than they were 2 months ago, which to me is setting up for that sort of trend line break to the upside. Right, so we've come in so much from that. We're at 50% long now based on this survey. We hit 30%, but that good contra indicator. Also, here's the bulls versus the bears. We had that peak in bullishness at 51% of survey respondents saying they were bullish. Again, that came in quite a bit similar to that NAA IM we just looked at, came into 32%, and for whatever reason, bounced, which I think is interesting because the indexes didn't bounce much last week, but bullishness did. So, thought that was interesting. But at least some of that sort of inflated bullishness came out during this pullback. And here's the net number. So bulls outpacing bears. Again, we saw briefly the bears outpace the bulls for one of those weeks. And it's not necessarily bad, right? You need bulls to have a bull market. So you're going to have more bulls than bears if you have a sustained bull market, and that's fine. But anyways, there was some excessive bullishness in this as well as some of those other indicators, and that's come back a little bit recently. Here's the put call ratio. This is priced as of, I guess, yesterday. Didn't quite update, but it's similar, right? Look at this is a big move over the last 2.5 months in put to call ratio. And so right when that ratio is higher, when there's more puts than calls, that's a measure of fear in the market. And that's almost getting to that danger point of that 1.15. That's kind of what we look at, that 1.15 number of puts to calls. And so, this is kind of setting us up. We were complacent. Look how, incredibly low, almost to that level. That's 0.8. And that's kind of what we averaged during that long bull market of 2020 to 2021. So we were kind of getting in that level, and now we've come up so much in the last couple months. And this is the equity put call ratio. So just looking at equities, similar story, big ramp in that level of fear to a point, close to that October. It's in that October range. The index is bottomed in October, and we're sitting here, on a 5 to 6% pullback in the S&P, and fear has really come back in the market quite a bit. Okay, and so a few more here. This is the high yield spread, the measure of credit risk in the economy. So as this thing is going up, that's kind of perceived credit risk coming up from the high in March with the banking crises and a number of banks going under. We've steadily drifted down here. So, this is something you want to look for. You want to look for a signal that the credit markets are about to get rocked by something. This is where you might see it first. And that has ripples through the S&P. Okay, and really the thing that's been making headlines through this whole pullback too in the last couple of months is oil prices coming up, coming back, and WTI sitting here at $89 a barrel. And so that that looks like a stock in an uptrend, right? So this is obviously not good for the Fed's headline number. And that's part of the reason why we're going to see that acceleration as well in the headline. But there are actually some tradable stocks. We'll talk about a couple that we own. And the I guess is it exploration or segment, I guess, of that oil complex. So I guess that is it. Yes, that was the last one right there.
Okay, thanks, Wes. Appreciate that. Any questions so far? And let me see here. Any questions regarding the overall condition of the market, current market environment right now? Okay, let's take a 5-minute break. We'll take a 5-minute break and then we'll come back and we'll talk about individual stocks. So we'll meet up here at 7:55. Okay, let's get started with the individual stock part of the presentation. Let me see. Let me share my screen with you. Do share. Does everyone see the Market Smith screen? I've got the NASDAQ currently on the screen. Do you give me a heads up? Do you see that? Let me hear verbally if you can see the NASDAQ on the Market Smith screen currently.
Yes.
Good to go.
Yes.
Fantastic. Thank you so much. Okay. What we wanted to do, first of all, we wanted to show you this is what we think are among the leading stocks currently in the marketplace today. Everyone wants to know, well, what do you own? What are you buying? And this is our actual portfolio currently. And then I'll show you our focus list as well, what we think are setting up to watch and that might be leading stocks coming out of this correction. But this is actually what we own in alphabetical order. And the first stock, of course, is Amazon. So Amazon's, what's nice about Amazon is Amazon's got numbers the last 2 quarters that companies like Apple don't have. You know, if you're screening for CanSlim type stocks, you typically want stocks that are growing their earnings at least 25% a quarter, 25% year over year annually. And of course, as these companies, these mega cap stocks get larger and larger, it's very difficult for them to have the same type of statistics, the same type of growth parameters that are typically portrayed by true market leaders. But Amazon has had two excellent quarters. Of course, they're right in the middle of the AI, and that's really the theme right now. It's the artificial intelligence component of increasing productivity that's from chat, from generative AI, among other things. And so that's the hot topic right now. And many, particularly software companies, are talking about how AI is going to produce productivity for their clients. And just in small basis points, but small basis points compounded thousands and thousands and thousands of times that can affect the profitability of the company. But Amazon is clearly right on the cusp of that. And Amazon broke out on the earnings report. And really one of the things that you want to see, that we want to see, is we want to see a company that responds positively to the earnings report. And this Amazon had an excellent earnings report. And of course, they're going to continue to be dominant in this space. They're going to be here for many, many years. They've got 2 great quarters back to back. Next year, earnings are expected to be up 48%. So it fits that bill of a large cap stock that's got small cap attributes. So there's Amazon. It just broke above the 143.63 level yesterday, and it has an inside day today. So, you know, if you're not long the stock coming in, it potentially might provide you a pullback buy, but nothing is wrong with this, you know, with this leading stock. So there's Amazon. We've been in Celsius since 94. I think we bought Celsius way back here at an early turn when the stock broke out on volume, and then it was followed by a great earnings report. And we've been averaging up on this stock for the last 3 or 4 months. You can see it's one of the only few growth stocks that were actually green today. So the stock was actually up $1.70 in a very abysmal tape, and that provides you, tremendous feedback. This is an easily understood story because of their calorie burning drinks, and their partnership with Pepsi is going to increase their market share. It's going to increase their distribution. It's going to really increase their sales. And what's remarkable about this company are the last 2 quarters. So David Ryan taught me 30 years ago that his greatest performers back in the 80s were those stocks that had triple digit earnings and triple digit revenue growth. So I constantly screen for those. I've got a screen that I run every day to see if there are any new stocks that hit that screen that might be attractive candidates. But this is really the among the best in the marketplace today, with tremendous revenues, tremendous earnings growth, and the stock is making new highs. You can see where the stock's just been basing. It had a minor pullback to the 50-day, followed by another breakout on the earnings. And what you want to see is this initial action where the stock breaks out on its earnings report. Normally it's followed the next earnings report. It continues, that momentum normally continues. And when it doesn't, then the stock is going to be very disappointing for Wall Street. Oracle, for example, had a great earnings report here, right here, followed by a very disappointing earnings report today where the stock dropped 13%. So normally when a major company has positive momentum, that positive momentum typically persists. For example, true market leaders normally have 8 quarters of beat and raised guidance. So that's 104 weeks about. And so you would not have expected Oracle to disappoint after having a great earnings report only 13 weeks ago. That's why the stock was down big on big volume. That cast a shadow on the market today. So people are reviewing the cloud stocks, they're reviewing the database stocks, and analysts are again looking at their numbers again. So this is clearly a headwind that we're going to have to work our way through, but you don't know if it's going to be company specific or if it's going to impact the entire industry. Only time will tell. CrowdStrike came out and delivered a terrific quarter. This is what you want to see. You'd like to see these stocks that are basing and then break out on the earnings reports. In a good market, you're going to have there can be literally 100 of these, and there aren't 100 of these right now. And what that is basically telling you, the market environment is still hostile for growth in a big way. But this is what you want to see. You want to see a stock that breaks out on big volume, that has really good numbers. And so, of course, this is in the security software area, just like Palo Alto Networks is, Fortinet, and Zscaler. Those are the primary competitors in the business. So it was a little bit touch and go on this quarter because you didn't know if they were going to have a good quarter or not. And just to point out, not Fortinet, FT&T, Fortinet just got bombed on its earnings report, and the stock was at a 52-week high. And that just shows you the risk many times going into the earnings report, and the stock dropped about 30% overnight in one day. So we didn't buy CrowdStrike going into the number because we didn't know if it was the industry or if it was just company specific. But CrowdStrike is certainly a leader right now with their 100% earnings growth. And you can see also that you've got accelerating numbers. For example, you had 40 cents a year ago, 47 cents, 57 cents, 74 cents. Among the greatest stock market winners, many of those companies had 3 quarters of accelerating earnings growth. And so this is a company that typically this is a company that has delivered that. So it's got the right screening criteria. And the stock acted well on the earnings report. You can see the stock is now in a stage 2 uptrend. The Chinese auto stocks have been perplexing. We do own Li Auto. We bought this about a week ago. And Li Auto has phenomenal numbers. You can see the earnings report last quarter. Earnings were up 900%. Revenues were up 200%. Earnings were up, you can see this, 26%, 165%, and 999%. And more importantly, look at the quarter over here that they're going to be comparing to. So this company grew revenues from 1.3 billion to 2.5 billion to 2.7 billion to 3.9 billion. So let's just assume they're going to be in the $4 billion area. I think that's the estimate. So that's going to be $4 billion in revenues for the quarter versus only 1.3 billion. So you're going to see a threefold increase in revenues, and it suggests that earnings, of course, are going to be they're going to be terrific as well. So this is clearly the leader in the group. You have two others. You have actually three others: BD, BYDDF, NEO, and XPEV. But this is the company that has the best numbers. You can see it's got a 97 relative strength. And their competitor, of course, is NEO, which you can see here. It's a $10 stock. That's at the bottom of the barrel. And XPEV, which this is a $20 stock and they're losing money. So when you compare Li Auto to their competitors, you want to buy the ones that are making 52-week highs and that have the best numbers. And Li Auto, in fact, does that. So you'd like to see this stock just go sideways. You can see a trend line that's drawn right there. And if you extrapolate down, it's going to be right at the trend line. So you can see I have an alert over here at about 42. So it needs to break that trend line on the upside, needs to break the alert on the upside, and that will tell you that now the stock's correction is potentially over. But you had this nice move, consolidation on some China shakes, and then the resumption, presumably, of the uptrend right here. But they got terrific numbers. We've got some rotation in the marketplace, guys. The rotation is, we've got a rotation into energy, and we do have a big position in this stock and Noble Energy and also Tidewater. And so you can look at the numbers, the revenue numbers for Tidewater up 132%, 190, 199, and of course 22. And you can see this great, nice sequential growth. And what I like about it as well is that, again, you're comparing when the numbers come out for next quarter, it's going to be another triple digit release, because they'll probably do 750, 800 million in revenues versus 305 million a year earlier. So this revenue number is going to even expand, and I'm looking for them to have a nice adjustment as well from an earnings perspective. So the stock is making 52-week highs, and it's very close to making all-time highs, which is very, very significant. And one of the things that I would suggest you do is screen for those stocks that are making all-time highs, not just the 52-week highs, because that is a small group. And those stocks that make all-time highs typically can go much higher. For example, SMCI, look at when this stock made an all-time high right here. That was 40. And so particularly stocks that go through consolidations, bases, and we have a lot of this going on. Look, that's really a 7-year base. When it finally broke out, it went from 40 to 300. And this was one of our biggest winners this year, where we bought the stock here at 123 because they had great numbers back here. Earnings were up 490%, earnings up 270. You had a 5% quarter, a really good quarter last quarter, but it was the stock had gotten ahead of itself. But we bought this stock here and we sold it there, and we bought it back there at the 21-day on the pullback, and we sold it before earnings on right there. I can draw that. I'm trying to draw the trend line, but it's right there on that break of the 10-day. And we knew earnings was coming up on it. We didn't want to hold it into the earnings quarter, but we don't necessarily think this is over. Anytime you have a big move like this, true market leaders, they don't typically exhaust themselves. I mean, it might, just because you had such a move from 100 to 350, but they typically don't exhaust themselves, in 3 months. These true market leaders normally go for, a year and a half or so, a year and a half, 2 years, 18 months to 2 years. So you definitely watch this. If this stock breaks back over the 50-day, then it will be put it in this somewhat of a cup, and that would be really sort of an early turn. But you want to see it get over the averages, because the stock is living below the average here, it's really not buyable. But when you see the stock break back over the 50-day, particularly if it's in volume, and it could be a new upgrade, it could be an adjustment to their numbers. It doesn't matter what it is, but what matters is will volume come in on the stock, and will there be price participation as well. But this is what it could be, putting in a cup and handle. And what would be totally normal would be if the stock would come up here to 300 to 310 and then handle for a couple of weeks, and then break out of that handle and go to new highs and make the next move up to that $500 area. But for them to do that, it's going to have to be earnings related. Nvidia is by far the biggest stock in the market. Everybody's watching this. I would guess that everybody on this call either has a position or you're watching Nvidia. Nvidia had remarkable numbers for a big company, and it's a $1 billion company that we think this potentially could be the next major winner in the market. You can see they're doing $5 billion, $6 billion, $7 billion to $13 billion a quarter. And when you have a stock, an institutional stock, that can grow from 7 billion to 13 billion, and they're sold out, and earnings are up 400%, revenues are up 100%. This is prime merchandise. This doesn't happen very often, not often at all. This has got Tesla's growth numbers that Tesla had in 2020. And rarely do you have a company that has this kind of numbers. You can see the stock reacted positively to this earnings report. And by those serial gappers, you want to watch these earnings reports. And many times we talk about having a stock that's got a 10% price appreciation, and the volume's up 300% higher than normal, and the stock's going to a new high. That's not a sell signal. That's really a buy signal. That's the trigger that you're looking for. There's another great earnings report. And then this earnings report, they sold into this earnings report, but it was a great earnings report. And so the stock just needs time to consolidate here. So you want to see the stock hold the 10-week. And this is going to be very important. See the 10-week on this stock, it's at 450. So you don't want a stock to close 3 to 5% below the 10-week. It's okay if the stock just sits right here and as we go through this correction, but I think tomorrow, if the number is, if the inflation number is friendly, you're going to see technology stocks have a big day tomorrow. And this would probably be the number one stock to go to in the growth area. So it's giving you an opportunity to buy right here at the 50-day. Now that's a double-edged sword. And I was talking to Wes about this. Normally you don't want stocks that are easy to buy at the 50-day. You can see down here when the stock, a month ago before earnings came out, there was some volatility, but you can see where the stock snapped back when it broke the 50-day one day, snapped back. It was hard to buy that day, and it hasn't seen that low since then. Whereby in the last 3 days, you could buy as much of this as you want, and so that gives me a little bit of caution. But if this stock takes out today's high and yesterday's high tomorrow on the earnings report, not on the earnings report, on the inflation report, it probably will have a really big day. Institutions will be piling back in this stock as they view the inflationary environment positive and friendly. So everybody's watching this. You can see it's got a 99 relative strength. Composite ratings 99, which is as good as it gets. And that composite rating consists of sales, revenues, the industry group, return on equity, etc. And those 5 things.
Rory.
Yeah.
I'm sure y'all aware of that. Is the informational core weave, the collateralizing $2.3 billion of debt on Nvidia chips. And that
Bill,
just worries me,
I didn't hear that. You were cutting out, Bill. What did you say?
Yeah, the informational core weave raising $2.3 billion in debt by using Nvidia chips as collateral. I'm sure y'all seen that. Any thoughts on that?
Yeah, my thought is that it's irrelevant. And the reason that it was so is I did see the report, but remember Microsoft is doing the same thing, if you're aware of that. Okay. And of course, the analysts, this stock is the most widely followed technology company on the street. And they would not have given them a pass if there was some inkling of fraud or impropriety or cooking the books. Basically, what the Twitter participants
shorters trying to short it.
Yeah, what he posted, he posted, a bearish slant on that, but it also, look at the volume, and when that was reported right here, it was less than average volume. See where it's trading less than the average volume the last 5 days. So there hasn't been widespread selling. If there was any inkling of fraud, and that being a legitimate argument, that stock would have gotten crushed on big volume, the way it would have acted like Fortinet, like on the earnings report. See what happened there? That's what would have happened if there was any merit. So, everyone's got an opinion, and people plant these stories. It's no, the bears are no different than the bulls. The bulls are writing positive articles on the company, while the bears obviously are writing bearish slants on the companies as well. Everyone's entitled to their opinion. That's the way that works. I don't necessarily feel badly for, bearish slants, because the bears are going to have to cover. So if it's a chess match, really. It's a chess match. So, but I think I'm more concerned with the price action. So you want to see this stock, you do want to see this stock hold right here. And, I think the stock's got terrific upside. And what's got my attention is, look at this. When you take a look at it from a long-term perspective, remember I told you about when stocks get into all-time high territory? And look at when they get into all-time high territory, look at the moves. And I am playing this just like this. I'm assuming that the fundamentals are going to be great. They're going to continue to have a leadership position over the next year. And everyone's, AMD's getting in the business, but AMD's not going to even have an artificial intelligence chip until next year. And, this brings, this is going to bring competition, which is good. But that's when I'm looking at it from a technical perspective, you can see when it broke out here at 8, the stock went from 8 to 80. When it broke out here, it went from, looks like 70 to 250. And when it broke out here at 350, this is why I don't think it would be out of the question that this stock can potentially go to $1,000, a year and a half from now. It is the leading stock in the market today, and it's wildly liquid. So it's a stock that everybody is watching and everybody is following, but it needs to hold here. A move off this 50-day would be very positive.
But don't you think that the stock has kind of gotten very much extended? It has kind of gone parabolic if you look at the monthly chart.
No, I don't think so. I don't think the stock is. The stock broke out here at 420. The stock's only up 5% from the breakout point of the last earnings report 3 months ago. These true market winners, these true market leaders that go up like 5 and 10-fold, this is the way they act. IBD has a great publication, and you can Google this, and if you don't find it, you can email me and I'll send it to you. And the name of it is America's Greatest Stock Market Opportunities, I think. And there's about 70 pages of leading stocks that have this type of criteria. And these stocks continue to go until the earnings either peak or turn down. And you can see the numbers this year versus, look at the next 3 years. Earnings are going to be up. They're going to be at $3 in 2023, $9 next year, $15 the following year. This is going out 2 years. So remember, there's 100% correlation between the earnings of a company long-term and the stock price. Short term, all kinds of hiccups can happen. News stories can happen. The market can be in a correction, but there's a strong correlation that the stock is going to move up, continue to move as long as the earnings trend is up. So if the stock's earnings were suggested to be down next year, yeah, I would think, okay, man, this stock's probably peaked right here. And you can look at it, Yogesh, you can look at some examples like Teladoc and Zoom, and you can see those stocks peaked when their earnings peaked. And, of course, they were big winners that corrected, 90%, after the 2021 top. I don't see anything like that here with the earnings projections of, up 187% next year and 57% this year, along with the earnings, that they're delivering this year.
Thank you.
You're welcome. PDD is, we own this stock, and we bought this stock on the earnings report. And for for Wes and I, and, a number of CanSlim investors, those we're looking at the subtle clues there of institutional footprints. And so we think that's we think that's the number one thing that you want to look at. You want to look at what the institutions are doing, and what are they doing, and how are they doing it, and what's the stock market reaction. It doesn't really matter what the earnings report is, but what matters is how the institutions respond to the earnings report. That's why many people, they can't understand, if you, like for Oracle, they didn't have that bad of a quarter, but why is the stock down so much when if a company hits their numbers or so? And it's based on based on a lot of things. It's based on forward guidance. It's based on really some things in the financials that don't show up imminently, but it's how the institutions react to the stock on the earnings report that's important. So this company had an excellent response to their earnings report, and you can see the last 4 quarters of earnings have been great. And we don't love China, but you do have a couple of these Chinese stocks that have, terrific numbers, but you don't know when the premier will pull the plug on any of these companies like Alibaba, Baidu, or whatever, and then the stock could tank. EDU, a notable one last year. But stock reacted great on the earnings report, and it's holding above support at the 10-day. And this is really what you want to see. And let's take a look at this from a long-term perspective. Looks great on the weekly. Look at this cup. And that's a handle this 3-week handle that it just broke out of to a new high right there. That's really pristine, a pristine reaction. And you can see as you look left here, there's not a lot of overhead resistance, over the last year. So it's at a 52-week high. So it's holding the 10-day. Now, if the stock breaks that low of 3 days ago, that would be, that's going to be either, it's going to need more time, or that's trouble right there. So we'll probably use that as a stop. It's pretty obvious, but we'll probably use that as a stop if it breaks that Thursday low. But it did go up today. It was up $1.48 today on a bad tape. So it's acting the way that you want it to act. Okay, the Qs. There's your downtrend line on the Qs. By the way, you can draw this uptrend line. See right here. See, that might be. See what might happen. And I mean, I don't expect this market to really come unglued. I expect it can potentially undercut that Thursday low, go to the trend line, and hold the trend line. So that's what I would suggest. I mean, that's what I think might happen. And or we just break to the upside right now, tomorrow. But, if we don't break to the upside tomorrow, we just might need to go sideways, another 5 to 10 days. But you do have trend line support, see right there. So don't think that you necessarily have to, go to the exits. You need to look at those individual stocks to see if they're holding support. What you want to see, what you would ideally like to see, is the averages consolidate and growth stocks that you're interested in move higher. That's really what you want to see. But there's great support, but we could undercut that Thursday low, go right there, and that would give you an area where the market might stabilize as well. And you can see I had this period illustrated too down here, where the market in the pullbacks, they typically undercut these some of these areas. Like you had this pullback here, see where it undercut for 2 days and then came right back. See, so you might, the next level that you might undercut might be this level right here, which would be the 354 area. So, if it gets, if the market does not hold the trend line, I would look for it to find support there at the 350 area, in the Qs. The S&P's same thing. It's been stronger. If the S&P breaks this downtrend line, it's really game on. So your support, see where I have the support area drawn here, right back here. That's the June low. That's, that would be, a pretty, pretty obvious, place for the market to stop, right, in that area. And I really don't see this market just collapsing here, because I think the market will be discounting that, interest rates have, the Fed has finished tightening, or they've got one more tightening. The Fed funds market indicators show that they're not going to raise rates in September. And so that puts us on a December time frame. So the market, that TNX is very important. And that's really a key, the TNX and US dollar to look for. So you want to see this, which hit the downtrend line. You want that. You'd like for this TNX, the rates to be lower tomorrow. And so that would be consistent with a friendly CPI number. And so if the rates are lower tomorrow and you take this little low out last Thursday, that's going to propel a pretty massive rally in the market. So from a timing perspective, I mean, there's going to be, I think tomorrow is going to be, a big day one way or another. And Tidewater, we're long this Tidewater. We bought this Tidewater, breaking the downtrend line right there. You can see where we bought this. And we listened to the earnings report from the CEO, and the CEO of Tidewater. These are the companies that make the offshore support vessels for the rigs. And from a guy that grew up working his way through college offshore of Louisiana, I'm very familiar with the industry. And the CEO said that this is the best part of the oil cycle that he's seen in the past 10 years. So that really got my attention there. They're dominant in this particular group, in this particular industry group. You can see the industry group is ranked number 3, and look at the earnings reports. And back in 2021, you had a number of oil stocks, and we passed on all these oil stocks, but we took a position this time. And so you can see they do have great numbers. And, the reason that we typically pass on oil stocks and cyclicals is because they are cyclical in nature. We can't predict the price of oil. We just, there's no way of predicting that. But when times are good, then you've got these earnings blowouts, and times are extremely good right now. And this is this is my favorite stock in the business. And you want to buy the stocks that are first out, that are at new highs first. You don't want to go through the oil and gas business and say, oh, this stock, it hasn't done anything. And so you are fooled into buying a laggard. You want to buy the leaders. So if you have missed the breakouts, you just need to wait for the pullbacks, because they will naturally have a natural pullback, and that will give you an opportunity to get in. But they are certainly extended right now. But what got our attention are these earnings reports. Look, 560%, 182%. And remember, CanSlim criteria, it suggests 25-25. And Tesla's been an enigma. We bought this stock yesterday for the first time, breaking above the 50-day. So, your Tesla's, quite controversial. They have cut prices a number of times. And just really, all year they've cut prices. We can never understand why the stock continues to go up when they're cutting prices, which will impact their margins. You can see the stock had that pullback like all other growth stocks had in July and August. And we of course, we're not bottom fishers. We're trying to guess the bottom right back there. And we didn't buy here below the 50-day, so it's important to not buy at the lowest price, but the right price. And the right price for us was the trigger when institutions stepped in on the analyst upgrade yesterday, and the stock moved from a neutral position to now in an uptrend. So for all you Tesla acolytes, they've got a terrific head start in the charging stations. That's important. And then, of course, their software and artificial intelligence expertise is next to none, and that propelled the upgrade from the analysts yesterday, which suggests that their artificial intelligence technology was equivalent to Amazon's AWS technology, which represents 70% of Amazon's sales. So the analysts yesterday suggested that their artificial intelligence, when they monetize it, it can impact Tesla's bottom line more than actually selling cars. So that's indeed a bold statement, and time will tell. But that's why the stock reacted the way that it did. Uber's been a leader, from this earnings report, and this is this reminded me when Facebook first turned a profit after losing money for years, and that's what changed the fortune on Uber on their earnings report right there. So they had a great earnings report. They were cash flow positive for the first time, and the numbers they're suggesting after losing money for 1, 2, 3, 4, 5 years, they're going to make money now moving forward. And so you had the first earnings report where they, where they made money. Earnings were up 114%, and then you had the second. Or this earnings report, they're up 114% right here, but it reacted positively on this earnings report because of the guidance. Then this is the last earnings report. That's what you want to see, a stock that's moving higher with this earnings drift up, drift upward. So it's above the averages. It's in a stage 2 uptrend. So this is an institutional liquid stock that is that many growth companies have. You can see 2,100 mutual funds or hedge funds own the stock, and all the IBD, many of the IBD A+ rated funds, there's Fidelity, Contra, all these A+ funds own the stock. So that gives you confirmation that the stock is performing good, that the company is performing great. And the last stock I wanted to touch is VRT. And again, the stock, look at this institutional footprint right there. And so this is, pay attention to these. I'll show you a few of these, and then we'll take questions. But that's really what you want to see. You want to see these breakouts on volume at a new high. And look at this. Look, there's the first time that it happened. So a trend change took place right there. And then on the earnings report, it happened again. Look at the volume down here, 38 million shares on the earnings report. So this company provides primarily cooling systems for these data centers. You know, the data centers need high-powered semiconductors, and that those high-power semiconductors fueled by Nvidia are very hot, and so you need cooling systems, and VRT is the leader in that. This is the company no one's heard about. I mean, look at the revenue growth. Look, 1.7 billion. Well, first of all, 1.8 billion to 1.6 billion, 1.5 billion, 1.7 billion. So they're doing $7 billion, and no one's heard of this company. And many times this is where these companies come from. You can see the earnings reports, and this is primarily because of the data center projects that they have underway. And it's got a $50 price target, the latest that I saw yesterday, and it's being propelled by its earnings report. So 360% last quarter, and growing solidly at that 25% area. And finally, I'll show you, you can take a snapshot of this. This is Wes and my focus list. We're looking at these companies. And so most of these have technical, when you go through these, they've got a great chart technically. And, they have most of these stocks have great fundamentals as well. So if you go through these, and you might have some questions on a number of these, but this IoT looks great. That ESTC reported looks great. Pure Storage looks great. Delo, Melly, Lilly, etc. So with that, guys, I'll turn it over to you. What would you like to look at?
Well, look at the
CHTR.
What's the symbol?
CHTR, Charter.
Oh, CHTR.
Yeah, I sat on that recent move and kicked myself.
So this is obviously in this telecom area, and so I guess there was some stuff going on with Charter, right? With what was going on with Charter and Disney recently? Charter, Disney,
Carriage agreement.
Distributing Disney content.
Yeah, what do you like about the stock?
Well, I think it's rated #1 in the industry group, if my memory is correct from last week. But looking at it back from July, that's a pretty clean move.
Yeah, you're cutting out on me just a little bit. This is let me just say, this is really kind of one of these value plays. So it's it's historically been known as a value play, and this is a perfect Mario Gabelli type of stock in the communications area. The stock's been in a decline for quite some time, and it's been in this downtrend for a couple of years. It looks like it is turning the corner, so it might fit into that criteria from a value perspective. It is above the 200-day. You've got the 10-day above the 21-day. So it might be, this stock might be in the beginning of a turnaround, of a comeback move. So currently it does not have the types of numbers that you would expect from an explosive growth stock. But it's not really a growth stock. It's a value stock. So it's a value stock that technically is improving, regardless of what the numbers are suggesting right now. The technical pattern is improving, and it looks like it has turned the corner. There is a lot of overhead.
Exactly. Well, August being a difficult month, also it was a good performer. So anyway.
Your speaker is breaking up, Bill. your microphone. Okay, next.
Take a look at the ARGX.
Oh yeah. Okay, great. Great chart. And this is, boy, what a quagmire. When you looked at, this is what happens with these biotech stocks. So obviously, something very positive, very powerful. What's one of their phase 2, phase 3 drugs that were good results, and that propelled the stock from 368 to 550. Stocks almost doubled. And the stocks pulled back there to that 21-day. And for this, you got to purely look at this from a technical perspective because they're not making money, right? But, you had a powerful blowout, the move to the 21-day where it held the 21-day. And if it were a power play, it'd have to go up 100% and then get this kind of action. Where it consolidates, that doesn't come back more than 10-15%, and then it re-embark on the move up. So the stock is technically pretty strong. And what's interesting is when I'm saying that it doesn't have any fundamental numbers, I don't think I've seen a stock with this much institutional sponsorship. Look at the institutional sponsorship.
Yeah, there's 11 to 20 O'Neill funds in there.
I mean, I've never seen a stock with 11 funds, O'Neill funds in it. I'll do more work on that myself to find out what's going on there. But you had great action, and obviously they've got something in the pipeline. I have been expecting this group in the biotech area to reemerge and reassert itself, but there's been so many of these where there's been blow-ups. And like for today, for example, SLRN, look at that. Stock was down 54% today. Stock was almost at a new high, had an IPO, so it sucked people in. Look, you've got some O'Neill funds in it, and then the stock, something happened and it dropped 54% overnight one day. So, forget about getting out at 8%. You just get, eviscerated. But that ARGX, definitely right now, there's something good going on. I definitely would be watching it. Look at it on the weekly. I mean, this is really nice, tight action on the weekly. A lot of times when you look at these on the weekly and monthly, they give you a better perspective. And look at that monthly breakout. So if it's going to be a leader, it's going to go up months. And it's nice that it took out, see that monthly bar, last month's bar. That's very positive. Definitely, there's something definitely going on that's potentially explosive from a price perspective here. Nice $30 billion market cap, 57 million shares outstanding. So the float's really small. A float of 56 million, that's really tiny. So definitely one to watch.
Roy, can you look at the snowflake?
Yes. I saw the CEO on TV today, and this is and I have followed this stock since the IPO, and the CEO was pretty audacious, saying that he thought that this was going to be the quickest stock in history that made $10 billion, that went to $10 billion in revenues. And it's, the stock, it's, obviously got great, great sponsorship, great technology, but the numbers have been disappointing for Wall Street's perspective. And it's been in this, it's been in a 2-year bear market. So I've got high hopes that it will reemerge. And there it is on the monthly. So you actually could, you could end up drawing a trend line there on the monthly. Of course, this is very steep, but I'm definitely watching the stock, and I think it got hurt today again with, with the Oracle news. But look, the 10 days above the 21 day for the first time, it's above the 200. The 200 day hasn't moved up yet, so you wouldn't say this is in a stage 2 yet. It's still in a stage 1 base. So it just needs more time. It needs time, needs to prove itself. When it gets going there, you'll know that it gets going when it takes out this overhead right here. And so how fast that happens will remain to be seen, but it is above the 200 day, but you do have the 50 day, but you do have a declining 50 day on it. So, you have this, that's known as an angle warning. So we'll see what happens with it. The CEO was quite ebullient about artificial intelligence today, and believes that they're going to be at the cutting forefront. All these technology companies, or the CEOs, are obviously saying that.
Roy, is there any way in which you evaluate these growth stocks from a fundamental standpoint?
Yeah, just the fundamental standpoint of revenues and earnings growth.
And that's it? Nothing on yields or?
Nothing on PE. So O'Neill, nor many people that buy growth stocks never look at PEs. It's really, of course, there's an art to it, trying to identify these and identify the patterns. All these patterns typically, mirror, and they look alike. So as a growth stock investor, you're trying to identify pattern recognition most of the time. So the fundamentals, the way that O'Neill, what he came up with was a composite rating, which is a fundamental criteria. And for example, he is ranked in this database the top 200 best fundamental stocks based on their composite rating. And I'm looking for it under my list. Composite rating. Well, it's going to be on it can also be on one of my columns. For example, here's the Market Smith Growth 250 list, which is a technical and fundamental list. And you have the composite rating. And the composite rating is a combination of all the best technical criteria that growth stocks typically move growth stocks based on their database and based on their algorithm. So you can rank, and these are the top 300 of the growth 250 that are ranked by composite. So this is a 99 composite. Rarely will I buy a stock that's got less than a 97 composite rating. And so you can see here, and so you can see here these are really the top fundamental criteria stocks out here in the Market Smith Growth 250. And most of you recognize a number of these. Of course, Adobe's going to report Thursday. That's going to be important. That's going to be big. But there's SMCI, which has been one of the biggest winners of the year. There's Splunk. There's that ESTC I mentioned. There's Celsius. Here's Cocoa that just broke out of the water company, the beverage company. You can see the ones that have the best fundamentals. Remember the energy group. Look at the energy group. There's that Tidewater that we own. Schlumberger service company. So they're going to be this is really what we advocate. There's CrowdStrike, there's Nvidia. We advocate having some of these screens and just go through the screens. And but we look at the composite rating. We look at the composite rating often in determining our our fundamental make or break list. And it must be, the composite rating must be on my alerts right up here. See, right here they are. See right here. So these are screens that we run. Stocks that have triple digit sales and earnings growth. Stocks that have 85 relative strength within 15% of an all-time high. Stocks that have up-down volume of greater than 2.0. What are stocks that have earnings up 20% this year and next year? Stocks where the relative strength ranking is within 5% of a new high. So these are all screens that you can run yourself. 100% earnings growth, 100% revenue growth. But here's that top 200 composite, and IBD and MarketSmith, they do this for you. So here's that fundamental list where just the composite rating. So these are going to be the stocks that have the best fundamentals. For example, MDB, MongoDB, it's a database company that has just blown the numbers out the last 2 quarters. However, it got hurt by Oracle today. And look at, so when you're looking, when you ask about fundamentals, Sumit, you see these are the fundamentals. Earnings growth 667%, earnings growth 375%, earnings growth 180%, earnings growth 500%. You don't have better earnings growth in any stock in the whole market than this stock right here. And so the stock's down from 600 to 400, and there's a response to the last earnings report. See, it had a great earnings report. There's your trigger to get in, the way we bought Tesla yesterday. And then it came back above the 50-day today, and then it came under it because of the Oracle news, which is in the database. It's in the same group. So, this is one of the best fundamental stories in the marketplace today. So look at that composite group, and if any of you guys want to take a snapshot here, you can do that. But we look at this stuff. We just look at over and over and over and try to get it down to the ones that are acting great. Like, see this D local. See, look at this action. This is what you're looking for. See, the stock reacted on its earnings report. And it also, this stock, the CFO for Meli, Mercado Libre, the CFO for 12 years joined this company. So as their co-CEO. So that's a pretty radical move for somebody that had it made in Meli, which is one of the terrific growth stories in South America right now. This is really great composite rating. You can see a 98 composite rating, terrific numbers. So the numbers should drive you fundamentally. If you're looking at the right things, you should be getting these types of responses. And then the technicals tell you when to buy. Now, that's easier said than done, but that's the whole idea.
Can you look at a firm, AFRM?
Yeah. I was wondering if this was an artificial intelligence story, just like Upstart, UPST, and this is the buy and pay later firm. And so, you know, the stock had gotten hammered from 176 to what's that, 8. So, you know, stocks, they do, they eventually turn around, and, you know, this stock's finally broken the downtrend. And, you know, some of these stocks do come back. You know, they do come back when they have this type of action and they break these downtrends. For example, let me show you CrowdStrike. And bear markets do this to you, but until they finally turn and break like these downtrends, it's, you know, it's a place to not fish, but it has broken the downtrend. And so that's quite impressive. See where CrowdStrike way back here, this is in the 2019, it dropped from 100 to 40. And then it broke the downtrend line, and then you had to move here from 60 to 300. See a 5-fold move. So it dropped, you know, it dropped over 50. Well, look at this. It dropped from 100 to 34. It dropped 70%. And then that was the shakeout on the 2020, you know, bear market bottom, where they just tossed the baby out with the bathwater. And then you had essentially, you know, you had a 6-fold move. And I don't think that a firm's got that type of, I don't think it's got those type, it's got to have the numbers. And, you know, I don't know these numbers. I don't know how good these numbers are. They've lost money the last 4 quarters, but, you know, they are turning the corner. So maybe it's in the stock, and this is what you want to see. There's your trigger. So remember, it's not the opinion that matters from anybody, but what matters is that. So, you know, this stock, you know, the stock broke out there, gave you your buy signal. So you have to see where it goes. But it's nice that it took out that 19.58 area. You know, it may have turned the corner. So,
Roy, could you look at INFA, please?
INFA. Informatica. It's got that AI in it, right? So it's got the AI in it. You know, the numbers aren't special. You know, they're not the type of numbers that I would look for. Revenue growth, not great. But there's the earnings, and I'm sure this was an AI. You know, they talked about AI, but the stock is, you know, it is above the 200-day. The 200-day needs to turn up. Remember, if for those of you that follow Meetup, he's got a trend template for a 1 month and 5 month. So he'll never, on his screen, and the screens are actually here on the weekly. They're up here on the weekly. When you open new stock ideas, you can find Meetup screens. But he insists that the 200 days got to be turning up at least a month. And for him to be in a stage 2 uptrend, it's got to be at least 5 months. So the stock broke out, came back to the 50-day. It's just consolidating. You know, maybe there's something. You know, obviously, if there's something that's going on there fundamentally that's going to lead to higher numbers and you know, better numbers, better projections, beating the expectations, that's something to monitor. But it wouldn't be something that I would follow or CanSlim process would advocate, because there's so much overhead where it's still down 50%. You know, I'd want to be closer to an all-time high. The ones coming out of the bear market, and there's so few of these, the ones that are going to move the most, they're the ones that are going to go to all-time high territory.
Thank you.
Hey Roy, any opinion on Nutanix? Any?
Yeah, it looks great. I really don't know what this. I don't know what this company actually does. But you know, I think they do similar to what VMware does. I think VMware's a competitor. But what I do know is it had great action on the earnings report. There's the volume, the first earnings report. Here's the last earnings report. And this is exactly what I would be looking for, you know, for stocks that just blast higher on the earnings report. Here, of course, you got shaken out. It pulled all the way back to the 50-day and 200-day. Now, that 10 days can probably be support on a pullback. You don't want to see this stock go to the 21-day, and you don't want to see it take out the low of the day that it broke out. That day, you know, the day that it broke out, you don't want to see that either. So as long as it holds above here, I'm trying to draw. Can't draw, my cursor's not working here. As long as it holds above the low of the breakout point, then that it's still healthy. And what you would want to see, and see, this is a better setup. If it comes in, say the market gets hammered, you know, for a couple of days. As long as the stock holds the 10-day and it's above the low of the breakout point, you know, that stock's buyable on the pullback. It should hold right there. And so I love the action, you know, in the stock. I love the action. I don't know anything about the fundamentals, but what I do know is what the institutions are doing. And they've clearly bought this stock the last two earnings reports. And look at this on a weekly. This is almost a 3 weeks tight. It's not quite, because it's not within. Well, we have, if it came in a little bit, you don't want to see it. 3 weeks tight is no more than 1.5%. Close no more than 1.5% for 3 straight weeks. But this is a really tight action. So you got the first move up, and it's just gotten tight. I mean, this is a really interesting, positive development. And then you look at it monthly, and you know, it needs to get above this trend line. So we'll see if it gets above the trend line. It's right at resistance. But, you know, with the action right here, the last 3 weeks, you know, a poke above this level, and it would be buyable. If there's a good report tomorrow, a friendly report tomorrow, you know, a stock like this with it's broken out like this, and the institutions are clearly have been in it, and you know, look at that decline in volume. See, so people weren't selling it. This is that's a very positive development. You've got 36% earnings next year and the following year, so the numbers are really good here, you know, in the area. It definitely looks interesting and positive. Oh, I'll show you a couple of these. How about, this is a drone company. So AVAV earnings are going to be up 113% next year. It's a small company, but look at this. This stock traded, volume was up 985%. And the stock was up 20% that day. And now look how tight the stock has gotten. And so you had that great earnings report. And of course, they manufacture drones. And, you know, very solid numbers, really a small market cap, 2.968 billion. And so it's just, this is quietly consolidating. So that had that signature that I'm looking for volume. ESTC is another one. Look at the report. See, I'm trying to get you guys to identify, okay, this is where coming out of the correction, coming out of the bear market, you don't want to be looking at all these stocks off the bottom. You want to see the ones that are most affiliated with their last earnings report. That gives you 13 weeks for the stocks to consolidate and drift up before the next earnings report, where you could, where you presumably could exit before the earnings report, or if you have enough profit built in, you could hold it. This ESTE, they're in the database company, just like MDB and just like Oracle. But this company sells technology. Say if you go on a website, and actually IBD, and if you want to search for all articles from Nvidia, then this is the software that provides that backbone for search criteria. So when you go to various companies' websites, they're using Elastic's technology for search. And of course, look at this. These were the earnings reports. See, 267%, 238%, 242%. And see, this is where, if growth improves, it's going to be companies like this that people really haven't heard of. And this is one of those that got hammered in the bear market, and now it's moving up the way the one we just looked at, Nutanix did.
What do you think of IoT?
Looks great. Love it. So Samsara, what I like about I had spent some time looking at a lot of these companies that just had terrific declines after they came public. They got caught in the bear market. They didn't have the numbers to justify the price. And then they come all the way back. And this is what's got you can see I have an alert here if it moves to all-time high territory. And so it's come all the way back. And when you look at it on the daily, and I actually bought this personally today, and I have a 29.60 ad, and then if it takes out today's high tomorrow, or takes out that pivot at 31, I'll press the position. But you had the nice move into earnings, and
here, Roy, question
pull
here.
back to the 10-day. Yeah, go ahead.
Sorry, just a quick question. So when you say you bought here, do you wait for it to, like, the EMAs to, or like the SMAs to catch up any bit, or?
I mean, it's right there. I mean, I just bought a pilot position in this. I bought a pilot position in this in a really negative market. And I would want to have a 10%. I would want to have a 10% position, and I just bought a pilot, to just, okay, it's on my radar, and presumably to action for tomorrow. But the 10-day right there is 29.60, and I'm gonna buy a little bit more right here. Then on the turn, if it'll turn and take out today's high, that would constitute a pullback buy. So I'm a little bit early buying the weakness right here, but I think it's gonna hold here at 29.60. And if it does not hold there, I'll just exit the position, and no harm, no foul. But I love the way that it acted on earnings, and I like the idea. I like the idea that it's near an all-time high, because these companies can go from 30 to 45, or 30 to 60, or 30 to 100, depending on their quarter, depending on how they do. They must continue to grow the revenues and earnings, and you know,
You know
they're in the fleet management industry.
Yeah.
Yeah.
Question, the chart you were showing before, where it's I forgot the company which you're showing. But how would you even take an entry in that? Like just if it breaks, yeah, like I would want to get into that, but you have a what? Well, how much is that a drawback to the 10-day or 20-day, right?
Yeah.
That's like massive. So
yeah, and the 10 days 4.6%. And so that's the, and I wouldn't, and this is the risk in buying something. I mean, it's extended, you know, it's extended. So if you bought it the day, you know, if you bought it the day of the breakout, then, you know, then you're not in, you don't have any chance of, I mean, you do have a chance of getting stopped out, but you bought it excellent. And then you can add on the pullback, you know, you can take a larger position. But if you're not in the position, and I'm not in the position, but if this stock would come in, you know, quickly, like just to, you know, say the market got, you know, really nasty, and the market doesn't have to get nasty. It can just, there can just be a rotation. But 34.60 would be a better place to buy.
right, okay.
So, I mean, I'm watching it. I mean, it's just like, you know, I mean, I'm watching these that I've mentioned to you.
Royal, can you take a look at ELF?
And boy, this is giving me heartache because I missed this one for sure. And I hope that some of you guys participated, but this is one of these. I don't know how I missed it. So it's a cosmetic company that they sell to Target and they sell to Walmart, and it's so it's apparently from my conversation with females, this is like the best cosmetics for the price out there. And apparently they did quite a bit of selling, and you can see the stock responded positive. Look at these earnings reports. See, I've never seen any, this is pristine. And look, this is going back here. I mean, so remember, true market leaders, remember, by definition, you want stocks that can double or triple or even more over 8 earnings cycles, over a period where historically they raise and guide numbers higher for 8 quarters. And there's 5 quarters right there. And so this is exactly, I mean, this chart epitomizes what you should be looking for, but it is extended now, and the stock sold off after that earnings report, and it did snap all the way back. They bought a company to increase their product line, and the stock made it this move up here. This, you know, but it came into the 50-day. Notice where it came into there's a 21, there's a 50-day, came into the 50-day, came into the 50-day one day, came into the 50-day. And I was looking at this, trying to compare this stock with like Nvidia, for example. And I was looking at Tesla back in 2020, how many times it came into the 50-day. But this is an interesting stock for study. And this is one. It's you know, I don't know if I'll ever buy it now. You know, I just missed the stock. But you know, the earnings justified everything that I've been talking about having the right earnings and having the right stuff. This stock had.
Roy, but with these big stocks, if you sit out through earnings, you miss a lot, right?
Yeah, and it's quite controversial. Should you hold a stock into the number or not? And I mean, all the stocks that I look at, I expect them to have really good earnings reports. I expected because Oracle had a really good earnings report last quarter. and they, they were very positive about future guidance, and they did not deliver. And so you were penalized, but I thought for sure, I thought, and MDB had already reported, and MDB beat their earnings estimate by 100% just, a few days before. And so, thinking that, led me to believe that Oracle would, they would beat as well, but they did not. So you just don't know. But, occasionally you'll, I've had a few of these in my lifetime where you get, these monster moves and you can just hold it and sit. Remember Livermore said, everybody quotes him, the big money is made sitting. But rarely can you identify these stocks. But look at the numbers. The numbers guided you to the stock. 25% revenue growth, 25% earnings growth, and the stock's making a new high in price. So all during last year's bear market, the stock was going higher and going higher. And so that is, that's really, it's astounding. It's astounding, but it's not mystifying. I'm not dismayed what happened. I'm dismayed that, that I missed this true market leader. I mean, this has obviously been one of the biggest, but we did get SMCI, so.
Wes, its claim to fame is that it does not use animal products.
Okay.
And the other key thing is that unlike ULTA, which went down, this has a better inventory management, so it did not have inventory problems.
Let's take a look longer term on it. See, look at this. See, look at this. And I even had this, like when it goes to all-time high. See right here. And see and that's why you should be looking at the all-time high list, not the 52-week high, but when the stock comes all the way back and then goes through this digestion phase, this distribution phase, just where, supply and demand, it's at equilibrium, and I forget what Kathy Donnelly calls this in her book. Forget. What do you call it?
Turbulence zone?
Yes. So, when these stocks come up in the turbulent zone, when they're rechecking their highs, it takes sometimes a little time to get through it. That's why, this IoT may be doing that, going through the 52-week high. But there's a signal. And look, and I use, for example, let me show you this. Let me show you this. I use trying to get on my stop share. I use bar charts, and that's what I'm trying to pull up. Let me move this over. And then share my screen. Share my screen here. Go to screen 3. Okay. And I use bar chart right here. And do you guys see bar charts? Does that show up on your screen right now?
Yes.
Okay, thanks. Okay, so I use bar charts and go over here to stocks. And then you have the new highs and new lows. I look at this every single day. And this is by 52-week highs. So you got the 52-week highs. Okay, so these, so you want to watch these, you want to look at these stocks. And then I also, importantly, I look at and this is the only place that I see it, the all-time highs. So these are, and this is like when, when SMCI made an all-time high coming out of the bear market. This is like ELF. making an all-time high, coming out of the bear market. So look at the all-time high list today. So that's it. But we have, you know, 6,000 or 7,000 stocks. These are the only stocks making all-time highs. All-time highs, where there's no overhead. There's Casey's Stores that just reported. There's at Coco, COCO, Diamond Offshore. There's the insurance company, KNSL. And so you ideally want to see stocks that have growth criteria. See, ELF had growth criteria. So that's what you want to be looking for. And there's Tidewater, see, at an all-time high. There's Walmart at an all-time high. There's Lilly. And we've, you know, we were considering Lilly plus NVO we were considering adding that new share S2 because of their numbers. And Lilly. And what do you guys see on your screen right now?
Your all-time highs.
Okay, let me change that.
By the way, Fix is like Vertiv.
Fix is like who? Workday?
VTV. You showed VTV earlier.
Oh, VRT.
Yeah.
That's that was who was that? Fix?
Yes.
Okay, let me pull that up. And pull this up, new share. There we go. But I mean, look at look at this. That's going sideways 20 years, guys, and then it goes into all-time high territory. See? 20 years, and then it goes into all-time high territory. And of course, you know, they've got, you know, everyone's aware of their obesity drug. And of course, NVO is the other drug company that has Ozempic and Wegovy. And so that's broken out. But you know, this is so this style, and this is what's got my attention is the breakout on volume there, the positive response there, and this is one that's right on the top of our list. Is institutional quality, and they've got two of the obesity drugs out there that are quite popular. So, you know, and you have two in the group, you know, you got Lilly and you got NVO, the way that you had Moderna and Pfizer, you know, they're the competitors there. And that FIX, let me pull that up. Yeah, so this is a little bit different. They're not in the server area. This is in the construction area. Like, you know, and this group's been quite strong. You know, this group, you know, TTI, I think Allen Transmission, just in this cyclical area, that's been, you know, that has been a leading group. But, you know, these are definitely cyclical plays. So, you know, you're not going to have the growth here that you had like in an ELF. And ELF was the perfect setup.
And Roy, how you see the estimate for 2024 in this time of the year? So, for example, ELF has estimates per market space is 14%. And also another stock like AXON,
yeah,
Axon,
yes,
they have nice setups, but the estimates for the 2024 are not as high.
Yeah.
So obviously
well,
they can be revised. So I appreciate your comments on that. How
sure.
you look at those numbers.
Let me take a look at that. Now, see the ELF. I mean, ELF. I might have been premature saying that. Hey, I might never buy the stock because I mean, earnings are going to be up 45% this year and 14% next year. So this is a pretty strong runway there. So by no means, and they're growing, annually, sequentially, annually as well. That's really what you want to see. Those are, I mean, maybe this stock goes up for 2 years, like I was espousing earlier. And to AXON, this is, and I've tried this stock probably 2 or 3 times in the last year, and there's the earnings report. And I'm not sure if I got caught holding this stock in earnings or not. I actually think that I did. I think I had a profit going into the quarter. Could have bought this stock here on this earnings report right there. And again, I was looking for the same kind of, there's the earnings report right there, expecting another positive earnings report, and they sold it on the number. And then the stock had this big sell-off in a downtrend, and then again gained back on right there. So I'm a little bit worn out with this one, but it's got that reoccurring revenue, the razor blade idea, where you've got the cameras, and now they're storing Taser. This is Taser, by the way. They're storing all their data in the cloud now, which seems to be a great source of reoccurring revenue. And once all these police stations sign up, like in Chicago and New York City, they're not going to ditch these guys. It's gonna, the barrier of entry is just, the stickiness is very prevalent once you join these guys. But anyway, the company had a good report with its last earnings report, but earnings next year, you're right, earnings next year are going on only to be estimated at 8%. But if they double that and they do 15%, this is and it's consistent, then that might be all that's necessary. It may be one of these companies that grows for many years because they're going to have consistent earnings growth of 15% a year. So and that is an all-time high too. Look at that. See, right, going over 200. And so, as you know, I've been talking about that all night. So there, game on. I mean, I'm pretty sure that I would be a buyer, getting into all-time high territory. If we get through, shaking, as we shake through this correction. So the action in the stock is quite, it's quite positive. And look at this, you have this really cup, and you've got this little cup, and it's just kind of handling right now. You got institutions in it, 1,000 mutual funds. There's a lot to like, and they're dominant in their business. So it's in our focus list. I mean, we're looking at it, and in a good market, see, breakouts will work. And right there, I mean, I'm sure I would own this stock at 230. And it's at a buy area right here. So if this market holds in and it takes that out, there's your place to add or even initiate a purchase. See if it gets through that resistance, that pivot. You've got a clearly defined pivot right there.
Hi, Roy. Any thought on Dell and Cisco?
Yeah, Dell, a great quarter. And look at the, I mean, this is, you know, a great quarter. The numbers, I mean, the numbers are not explosive, but, you know, the reaction was explosive. So Dell and Cisco both reacted great to the quarter. And, you know, look at that. That's an all-time high territory. So, you know, Dell might, I didn't listen to the earnings report, but more than likely, what I did hear, I saw a headline that PC sales were supposed to be up, but remember they're in the server market too. So I've got to take a look at that, but this is definitely very bullish action and definitely, you know, potentially could be bought coming into the 10-day. And see, that's what you want to see, where the 10 days rising. And if the market gets hit and it comes into the 10-day, it can still be above the low day of the breakout. So that's a quite bullish, that's a quite bullish chart. Big earnings, so Dell looks great technically. I mean, the fundamentals here, I don't know about the fundamentals, but they must be getting involved in the data and the data service server area. And Cisco had a good report. And earnings. So, you know, big company. I've been waiting for this company to reinvent itself. Look at that. It peaked in 2000. This stock's going sideways they were the biggest stock, one of the biggest stocks by market cap in the market at the 2000 top. And look, it hasn't gone anywhere in 23 years. So that's why you can't get stuck on these stocks. And because when they do, you know, when they do peak and roll over, you know, sometimes it takes many years to get back. There's Microsoft, it took 17 years to get even. But then it went to all-time highs. That's why I'm preaching about this all-time high. And look at this, after it went to all-time highs in 2017, it went up 4 years before you had a major sell-off there. So wouldn't it be nice to just, you know, buy something like that, and it's something that goes from, you know, 50 to 250, you know, in 4 years, and you sit the whole time while the market's gyrating around.
Can you look at PSTG?
Yeah, it looks, I think we looked at, did we look at this earlier? This stock looks great. And it responded, you had this shakeout, and you know, you had this shakeout and this slingshot back up after the earnings report. And so you had your shakeout +3 buy on it. Now it's coming back into the 10 and 21 day. So, you know, it had this good earnings report earlier where the stock moved up after the earnings report. Right there, consolidated, pulled back on the earnings report, but was strong enough to come all the way back. So very promising action. The way the stock is acted, and 92 relative strength, 79 EPS. Not ideal, but if you screen, I have a screen with those stocks that are 70 to 79 EPS, and the relative strength is over 85. And a lot, you know, sometimes I get a number of those stocks that turn into be big winners. Let me show you that screen, for example. And these stocks aren't going to hit the IBD screens like the IBD 50 or the top 200 composite, because they don't have the earnings per share rank, but they can turn into that. And what got me interested in that is back in when I just began the business in 88, 1990, 1991, I had a couple of growth managers, and I was following CanSlim at the time, and you didn't have your typical 85 names. You had stocks that had this EPS between 70 and 99, and they turned into big winners. So let me show you that screen. So that's why I've been following that for 20 years, 30 years. So my screen, EPS. $70. Let me see if it's on my list here. I don't see it here. Earnings per share of 70 to 79. I've hidden it somehow. I don't see it. I can't find it here, but that's the criteria that I use. Okay.
Can you take a look at OVIX? They had some promising news. They're entering the payment processing market as well now.
WIX
looks like a inside day or inside on a
VIX
weekly.
has a sales problem. If you go back in time, you look at the prior sales, 5 years, 3 years, 1 year, it's dipping badly, and that's one reason why this isn't taking off.
Hey, Roy, can you comment on FFGI, IBD 50? Why the performance is not as good as stocks in the basket?
What's that, Alex? What's that?
So I'm wondering why IBD 50, the FFTY.
Yeah.
Performance is very poor, and they still recommend the same stocks.
Yeah, the performance is poor. And what was the last part?
But the composition of this basket is all stocks they recommend highly.
Yeah. Now, this is an algorithm, and this is what I mean. Look at this. And so there are periods of time and where, I mean, and really, CanSlim is really looking at the stuff that we're talking about tonight. You know, CanSlim stocks reflect many times stocks that are on that IBD 50 list and in the Market Smith Growth 250 list, and the 85 week in review list too. But it's an algorithm, Alex, and it's a benchmark, but they don't change. Excuse me, it's different from example from like ARC, where Kathy Wood never changes her stock. She rides them all the way down. But IBD constantly, it's a mathematical algorithm. They refresh their list. So it's not the stocks on the list at one particular time, because it's like a balance sheet report. That's like at one point in time, there's 1,000% turnover in this FFTY. So it's 100% turnover a month. And so many stocks don't stay on the list that long. And if they don't, that's one thing that's going to be reflective of a very poor environment for growth. Just like from 2000. So if you're in the FFTY, that's a round trip where, you're back to, you hadn't made money in 8 years, right? From 2015 to 2023. because that's the bear market that we've been in. But what I'm, what I share and what I want to share is that when you finally get in these upturns and these indexes go up 100%, you make 200. When these, so there's this bull market from 2015 to 2017. Here's the 2018 to 2019 bear market in the subsequent move up. Here's the 2020 bull market right there. And so you had, all these years, you had the opportunity to make over triple digit numbers. But then this is the worst bear market correction that we've had in 8 years. And if you look at the IBD 50 index, and you can see a longer term perspective, but the point being is that there's not, we're looking at the bottom of the barrel. This isn't like 2020. And, I was in that U.S. Investment Championship in 2021 and came in second. Mark Minervini was first, and I had a 214% year that year in my personal account. But the IBD 50, doubled. So you had the wind to your back. Now you haven't had the wind to your back for over 2 years. So this is what the point being is, my belief is that growth, it's going to come out of here. It always does. And growth is going to rocket ahead, but you don't know. We just need more time. We don't know if you can come down here, but this is clearly, it looked like we were, in that new upturn, a month ago, and then they sold into it. So, it's biding its time. It's biding its time. But the stocks in the IBD 50, like at 2020 and the beginning of the bull market, they all were there. Teladoc was there, Livongo, Datadog, Zoom, all the big Twilio, they were all there. And they were all making 52-week highs. So that's the point with looking at this IBD 50. It's just, this is where typically, I fish, in this area, because, and most of us, we're trying to have a triple digit year, but you can't, it's almost impossible when you're, when you have a headwind.
Yeah, I have a feeling that stock makes into list of 50 when it's overextended. That's my feeling.
Honestly, it seems like the IBD 50, because it's an ETF, it's not so much what's in it at any given time. It's a matter of how it's managed, and that it's always invested when it shouldn't be.
But if they rotate stocks, if they rotate those stocks, then it should not go down that much, and it should perform better this year.
Well, the reason that I look, and let me see if I can pull something up real quick. Hold on. But this is the IBD 50 index. So this is going back 11 years. So this is the actual index. And so the IBD ETF, which is FFPY, it's based on the IBD 50 index, but you only have a 8-year history here. You have an 11-year history here. But this is, and you can see this, even better. And these are those, what I want to point out. There's your bull market. There's your bull market. There's your bull markets. But sometimes you go here 2 years before you make new highs. And so, it's been in, that's what's going on in this group, over the last couple of years. And to me, I'm very, I've been doing this 35 years. This is getting me somewhat, excited about the opportunity, because I know what's going to happen. All the stuff that we looked at tonight in terms of the breadth, the sentiment, man, it's lousy. And really, you don't want to bail right when, the turn takes place, right when you miss the turn. Let me pull something up. I mean, I don't. I've been waiting for this for a solid year, and I know, I know it's going to come back in favor.
So ILF again, it's in their list, and under what circumstances you would buy it?
Who's that? ELF?
Yeah, ELF.
It's just too extended. I mean, it needs to come into the 10-week. I mean, it's just it's so extended, and when you've had, I mean, that's really parabolic. So there's probably it's gonna have to consolidate for probably a long time. There's that SMCI, which, I mean, that ELF is even more, looks like even more extended, but this stock went up sevenfold. So like this is how they look like when they consolidate. So you would need to see some kind of sideways action, like a 3 weeks tight on ELF. That would be the first thing. You'd want a 3 weeks tight, and that's where it makes no further movement up, but it goes sideways for 3 weeks, and then it breaks out. See, like right here, see, there's your 3 week tight right there. It would need to do something like that, but I mean, it's just going straight up. So this is
you're on a monthly chart right now.
Thank you. So there's the weekly breakouts. You can see these weekly breakouts. It's just, it's just extended. Yeah, it's I don't know. I don't know what to say. I don't know. It's here. I don't know. I mean, it's gonna probably come into the 10-week, which is 125. So I would be I would want to buy it at 125 on a pullback. That would be if I must own it.
Yep. Thank you. Thank you.
I was looking for on IBD. Give me a second here. I wanted to see something. Pull something up here. And share my screen. IBD. Oh, by the way, this is from the newspaper, from the electronic version. But what's nice, and they do this weekly, So you have all these charts, and this gives you a great thumbnail so that you can see what we've looked at tonight. This is a miniature version, a snapshot of MarketSmith. So, you know, so you can see that, I mean, I am looking at all these stocks because they tip, you know, some of these stocks can stay there for a while. This RELY looks very interesting as well. There's ANET, which also is setting up again. But this is when you see the thumbnail like this gives you a different perspective. But you find many of the leaders, they're going to be in this, you know, they're going to be on this IBD 50 list. But again, this list, you know, populates quite often. Still looking for something. And see if I find it here. Right here. Okay, so this is like, and I've got a, oh, darn, what happened to it? Right here. Let me change this. So this is why I'm a growth investor. So this is the IBD 50 index return, and this is going back 20 years. So this is going back 20 years. And this is where we are today. So the IBD 50 has returned 13.5% per year for the last 20 years. And the S&P's returned 10.6%. And if you missed, you know, and you missed these bear markets and you missed, you know, a portion of the bear markets, you're going to do significantly better. Then this is just taking the IBD 50, and again, it's an algorithm. They're populating it all the time, but they keep you in. It's fully invested, and so you can see the magnitude of this drop. That's what we just experienced. You know, the worst in the last 20 years, and this is why. You know, this is why I'm pretty excited. I know what's coming. This is going to come back in favor. And you can see in the 2007, 2000 bear market, you can see the 15, 18, you can see the 2020 bear market there. And this is by far has been the worst, bear market we've had. So right here, this IBD 50 has averaged 13.5% versus 10.6. That's why I pay attention to it. It's just a benchmark. It just provides context. So it would not be unreasonable to make 20% a year for 10 years. That's not unreasonable at all. But you've got to have your style into favor, and it can't just be a rotation kind of a thing. It's not going to happen in the S&P. You know, you're not going to average 20% a year for 20 years. But you can certainly do that in your own account, you know, with tactical timing and so forth. But that's why I pay attention to that.
Yeah, thank you, Roy. Yeah, you manage positions, you're exiting, I guess. This is why your picture is different from that in terms of drops.
What's that?
In terms of drawdowns, you're waiting for entries, you're exiting, and this is why your picture is different, I guess.
Yeah. But that's the nature of what we're all trying to do is, you know, that's ideally what you're trying to do as a growth stock investor. You know, it's never buy and forget about it. But everyone that I know, and you know, including me, you have many losses. You just, you know, you try to make them up, and you do make them up with, you get some of these home runs, you know. So you know, I equate it to being like a long ball hitter.
Yep, thank you.
And it's a matter of concentration too, guys. You know, Bill O'Neill often said, and he was a billionaire, I think, when he died a few months ago. And I know people that knew him, that worked with him on the team from IBD for many years. And many times he had all his money in one stock. And he had to temperament and the persistence and the belief and so forth to do that. But imagine having, imagine having 100 million or 200 million in one stock. And he often did. And, he articulated to everyone that concentration is the way to go, to put all your eggs in one basket and watch that basket closely. And, in a bear market with 35 positions, that's not going to temper the downside. More than likely the markets can get all of them. But, we typically want 10 to 15 positions. We have 13 positions right now. And, if you have too many positions, like 30 or 35 positions, that's going to skew your performance it's not going to help you any more than, having 5 positions that you're watching closely in your personal account. I mean, for my personal account, I rarely ever go over 10 positions, and normally 5 positions, and I've had half my account in Nvidia several times, this year. But a lot of people can't temper that, or can't take that type of that type of risk, or that type of anxiety, and it goes with the territory. But we do think that like 5 to 10 positions is what most people should do personally. And we try to, 10 to 15 positions, that's our aim.
Yeah, thank you.
You're welcome. Guys, we'll go about another 5 minutes. So hit me with anything that you'd like to look at here. It's, it's all about the dollar and interest rates. And let me see what futures are doing.
How does the Adobe chart look to you?
Okay, let me pull that up. And for those of you guys, this is let me show you this. It's my share screen. And are you looking at Adobe right now? Am I sharing that screen?
No, sorry, it's not showing up.
Okay, let me find it. Let me find my.
One easy way to find it is do Control Tab, and you can circulate through all the windows that you can't see.
Control Tab?
Yeah. Mm-hmm. Just keep doing Control Tab, 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 tab till you find the right one.
Thank you. I'll try that. And I see it right here. So Adobe is right in the middle of this AI explosion. So there's the Adobe chart. They report Thursday. We're expecting a really good report. And you really have the dominant players in this artificial intelligence. Let me touch on a few of these names. I mean, the dominant players, they're Nvidia, Adobe, ServiceNow, NOW, Palantir, which is the second tier name that we were long and got kicked out of, and Microsoft, Amazon, Google, Meta. And Adobe is right there in terms of their tools and their software design and capability and the AI implications of that. They're right there. So stock, it came into the 21-day, and earnings are in 2 days. So it's all going to be predicated and dictated on the earnings report. The problem with this Adobe is Oracle, just reported. It would be really difficult to enter the stock before the quarter, before the number. And it's at the 21-day. So if the market rolls over tomorrow, it'll go to the 50-day right there, which is 525. So that's going to be down another 20 if it goes to the 50-day. And you had a bad close today, breaking the 10-day, holding the 21-day. Nothing's wrong yet. Nothing's wrong yet. You broke that downtrend line. It responded really good to the earnings, and this is the hype with AI as well. So it's got everything that you're looking for, and it's just gone sideways. So the earnings report is going to dictate everything. I mean, it's on my buy list, but I'm not going to buy it in front of the number because of what happened with Oracle.
Right.
Thank you so much. Thank you.
Yes.
Right. There's talk of the market going to 4,200, which I'm sure you're aware of. You even mentioned it.
Yes.
Do you take any precautions, or do you do anything, or just hold on to your stops and
I'm good. We are. I mean, if this market sells off here, I mean, obviously the two ways to hedge. First of all, I mean, we have some big profits in Celsius and VRT, and we're up in just about everything. So we're gonna let the stocks tell us, not necessarily the indexes, but it might make sense. If this market breaks Thursday's low, it might make sense to buy some inverse ETFs. I mean, I will be looking at that. But, we have, tomorrow at 8:30, that's when the numbers can be released, and you'll see the impact there. And frankly, I would just like to see sideways action, because I think we're going to just work through this. 4,200 is not, it's not that much. But SPY, let me see, window, change my date, 09/12/23, and new share. I mean, this is so this is the S&P 500. I mean, we're still in a buy on the technicals on the MACD. That's still green. The green line's above the white line, but we're right here where we're going to go one way or another. And so, you've got some factors there. There's the upside. There's your trend, there's the trend line. But if the market macro gets worse, and by get worse, if interest rates go from 4.2 to 3 to 5% on the 10-year, then that's the only way we go to 4,200. It's going to be all about interest rates. And it's hard for me to believe that interest rates are going to go there. I don't think they go there with one more tightening. I think they just, it's going to be I think it's going to be in the market. But if we just get tight here, this is really what you want to see. You want to get this, you want to see this would be a perfect volume contraction pattern. It's okay if it comes down to the trend line and then bounces up there and trades in this narrow range and then breaks this up trend line. But if it does that, then that's going to be very, very, very bullish, where you should be all in, you should be buying, breaking that level on the upside, and then taking out that high, you should be pressing it, because everything's gonna be in gear, if that happens. And if that happens, then it's gonna be predominantly because rates are going lower and the dollar's going lower. And that's gonna be the key, that's gonna be the signal. Which has nothing to do with earnings. It's the dollar right now. It's the dollar and earnings, and the fact that that growth stocks are valued differently from a discounted cash flow basis, using a PE multiple based on the implied interest rate that you're using for the calculation. I know that's a little bit in the weeds. Guys, I think I'm gonna call it a night there. I certainly appreciate you attending. Hopefully Wes sent you the link to sign up if you're not on our mailing list. We send out correspondence occasionally, once or twice a month. But if you want to get, our summaries and overviews and things like that, be sure to be on our email list. If you're a member of this group, you're automatically on the list. But if you haven't joined, just send me an email in the chat, and be happy to put you on there. And wish you guys great success in your trading, and keep it tight. Don't get too negative here. We've seen what's been going on with growth. It's going to be a remarkable turnaround. And by the way, you might want to watch that rotation, the small caps, the IWM, which is at a big low. And particularly when you look at the IWM over time as well, the IWM, let me just show, and I'll end on that. Let me show that to you. New share. Screen 2. And I mean, look at this. These are small caps. You're essentially, that's at a 5-year low. That's a 5-year low. You're back to levels where you're flat for 5 years. And when you go through these periods, I mean, bad periods are followed by good periods. Bad periods are followed by good periods. So, if you bottom here and the good period, you're going to be way up here. And so you have, tremendous upside right here from this 150 area, to that 300 area. And that's the indexes. And again, as I've stated before, if the indexes, you can find stocks that do twice the indexes. That's the whole asymmetrical opportunity that you're looking for. So don't give up right when you can have a rotation here. It's just a matter of time, but and it's been a long time in terms of the duration and the magnitude of this bear market. It's as bad as it's been in 20 years.
That's what they're saying at Alabama and LSU. Don't give up.
I'm an LSU Tiger. I'm a fighting Tiger. We'll never give up.
Go Tigers.
Guys, thank you guys. Have a great night.
Thank you, Roy. Thank you, Luis.
Thank you, Roy.
You're welcome.
Thank you.
Thank you.
Thanks, Roy.